has been some debate about how the recent volatility in the financial markets might affect the path of interest rates. One view goes like this. The Federal Reserve realized that the banking sector has a limited capacity to absorb high interest rates, and despite stubbornly high inflation, the Fed increased its policy rate only 25 basis points on Wednesday and could start cutting rates soon. This is not our view. We don't think the Fed is easing up on its fight against inflation because of concerns about financial stability. Instead, we think US monetary policy remains squarely focused on inflation. So, if inflation stays elevated, rates will likely rise further, making market expectations of near-term rate cuts appear overdone. Let's take a closer look. The Fed has long maintained that its first line of defense against threats to financial instability is its Financial Stability Toolkit. This toolkit includes the emergency lending facility that the Fed put in place following the collapse of Silicon Valley Bank. The Fed doesn't view its monetary policy as part of its usual toolkit to address threats to financial stability. In fact, Fed Chair Jay Powell made the point Wednesday of keeping his discussion about financial stability separate from his discussion of monetary policy. For the Fed at this point, the mission of monetary policy is to restore price stability. We are not saying that monetary policy isn't affected by worries about financial stability. We think it is, but only indirectly. Let me elaborate. Over the past 18 months or so, the Fed has focused on tightening financial conditions with the ultimate goal, of course, of fighting inflation. Indeed, up until recently, financial conditions were tightening primarily in response to Fed rate hikes. But in the last 2 weeks, financial conditions tightened mostly as a result of rising concerns about the banking sector. If persistent, this tightening could reduce the flow of credit to business and households and ultimately weigh on economic activity and inflation. The subtle but important point here is that as a result of recent events, the Fed may well end up taking a less aggressive path on rate hikes. But if this were to happen, it would not be because the Fed fears that banks wouldn't be able to absorb higher rates. Instead, it would be a matter of the market doing some of the Fed's job, in effect contributing to the tightening in financial conditions that the Fed sees as needed to bring inflation down. We think inflation will determine the path of monetary policy going forward, but we view inflation as unlikely to fall enough to warrant any rate cuts this year, contrary to the market view. On Wednesday, Powell said that while inflation has moderated somewhat since the middle of last year, more recent data suggests that inflation pressures continue to run high. So, for investors keen on the direction of interest rates, we believe inflation and labor market data remain the key factors to watch. Bouts of financial instability matter only to the extent that they leave a lasting imprint on credit conditions that could in turn lead to a cooling of the labor market and a faster easing of inflation pressures.